Something huge is about to happen to UK pensions. It's a change that could completely rewrite the financial legacy you plan to leave for your family. What has for years been one of the smartest, most tax-friendly ways to pass on your wealth is about to be hit by inheritance tax. So let's get right into what this means for you.
Now, to help us get our heads around all these complicated changes, we're drawing on a fantastic, detailed analysis put together by the experts over at the renowned UK firm, My Tax Accountant. They've gone through the new laws with a fine-tooth comb to give us the clearest picture of what's coming down the track.
Just take a second and think about your pension pot. You've probably spent decades working hard, saving, making smart choices to build it up. You imagine it going to your kids, your loved ones, giving them a bit of security. But what if a massive chunk of that, we're talking as much as 40%, was just gone, vanished in a tax moil before they ever saw a penny? 40%. That's not just a random figure I've plucked out of the air. That is the standard rate for inheritance tax in the UK, and that very number is now hanging over the future of pension inheritances. It's a simple number, but believe me, its impact is anything but simple.
So, circle this date on your calendar, the 6th of April, 2027. From that day on, this 40% tax scenario becomes the new normal for a whole lot of UK pensions. The rules are changing, and the clock is definitely ticking. So over the next few minutes, we're going to break down exactly what's going on, why it's happening, and most importantly, what it means for you and your family.
All right, so here's our game plan. We'll kick things off with why this major tax shift is happening. Then we'll dive into the new rules and walk through a real-life example to see the impact. After that, we'll look at how to navigate the new process, check out some key exemptions and strategies, and then wrap up with your next steps. Okay, first things first, the big question is, why now? For years, pensions have been a safe harbor, a key part of estate planning precisely because they were outside the reach of inheritance tax. Well, the government has decided it's time to close what it sees as a major tax loophole. And this is straight from the horse's mouth. This is the government's official line. Essentially, they're saying that over the last decade or so, pensions have kind of accidentally become this super powerful tool for passing on wealth completely tax-free. Their goal with this new policy is to stop pensions being used as a primary vehicle for that, and to bring them more in line with other assets like property or savings. And this isn't some minor tweak affecting a handful of people. Just look at the potential impact here. Government estimates suggest that about 38,500 estates will end up paying more inheritance tax every single year because of this. But here's the real kicker. Another 10,500 estates will be dragged into paying inheritance tax for the very first time. So for nearly 50,000 families a year, this is a really big deal.
Right, let's get into the nitty-gritty. What exactly is changing? The new law is very specific about which pension pots and which death benefits are going to be included when an estate's value is calculated for tax. Understanding this difference is absolutely key.
So the main target here are what we call defined contribution pensions, or DC schemes. This is probably the pension you have. It's the most common type of private pension today, where you've got a pot of money that you and your employer pay into, and it grows over time. If you have a personal pension, a SIP, or most workplace pensions, chances are it's a DC scheme. And you really need to listen up. Okay, this table is absolutely crucial, so pay close attention. On the left, you see everything that's being pulled into the inheritance tax net. We're talking about your main unused pension pot, any funds that your beneficiary might have already put into drawdown, and a few types of annuity lump sums. But, and this is a big but, look at the right-hand side. There are some really important exemptions. The biggest one by far is that any money paid to a surviving spouse or civil partner remains completely exempt from IHT. Phew. Another bit of good news, death and service benefits are also safe. And finally, any payments to registered charities are exempt, as are dependents' pensions from those older final salary or defined benefit schemes. Okay, numbers and tables are one thing, but what does this actually look like for a real person? Let's put some real pounds and pence to this to see just how massive these changes can be. This is where the theory hits reality. And stay with me here, the difference might genuinely surprise you. So let me introduce you to David. He's 62, a freelance graphic designer living just outside Manchester. He's had a great career, owns his own home, and he's been really diligent about saving into his pension. His plan is to leave everything, including that pension, to his 2 grown-up children. Let's crunch the numbers for David. His main estate, so his house and savings, is worth £400,000, and his DC pension pot is a healthy £700,000. Under the old rules, so before April 2027, only the £400,000 from his main estate is looked at for IHT. After the tax-free allowance is applied, the tax bill for his kids comes out to £30,000. Manageable. Now, let's fast forward to after April 2027. Suddenly, that $700,000 pension is thrown into the mix. The total taxable estate is now $1.1 million, and the inheritance tax bill, it skyrockets to $310,000. That is a difference of $280,000. Just let that sink in. That's money that now goes straight to HMRC instead of to his kids. Wow. That example really hits home, doesn't it? It shows the massive financial stakes, but it also raises a bunch of practical questions, like if there's this huge tax bill on the pension, who's actually responsible for sorting it all out and paying it? Well, the government's answer has created a whole new process to follow. And here is the absolute key point. The legal responsibility now lands squarely on the shoulders of the personal representative of the estate. That's usually the executor named in the will. This is a massive, massive shift. It means the person who's managing the main estate, the house, the bank accounts, is now also on the hook for tax on an asset, the pension, that they don't even directly control. As you can imagine, this creates a whole new world of challenges.
So this is the new journey a personal representative has to go on. We can break it down into 5 key steps. First, they have to get in touch with the pension scheme to let them know what's happened and get a valuation. Then, they have to gather all the other info about the estate to work out the total tax bill. Step 3, they file the paperwork with HMRC and arrange to pay the tax. It's only after that's done that the pension beneficiaries can usually access the money. And finally, they have to be ready to handle any changes if the estate's value gets adjusted later. It's a lot.
Okay, so we understand the problem. We know the process is complicated. Now for the most important part, the solution. What can you and your personal representatives actually do to prepare for this? Well, the good news is the new rules do offer some flexibility, and there are some smart strategies you can use to manage the tax bill. The good news is there's some flexibility in how this tax bill can actually be paid. You've basically got 3 main options. The first is the personal representative can use cash from the main estate to pay it. Second, the person inheriting the pension can choose to pay the tax out of their own pocket. Or third, and this is a really important one, the beneficiary can tell the pension company to pay the tax directly to HMRC from the inherited pension money itself before they receive the rest. This is great because it avoids having to sell other assets, like the family home, just to pay the tax. And here is a fantastic pro tip. This is a real game changer. The new law includes a powerful tool for personal representatives called a withholding notice. This gives them the legal power to tell a pension scheme to hold back up to half of the pension fund for 15 months. Why? Well, it's a safety net. It stops a situation where a beneficiary gets all the pension money and then disappears, leaving the personal representative personally stuck with a massive tax bill they can't pay. It is a vital safeguard. We have covered a ton of ground today, from the why behind this huge change to the practical steps and the smart strategies. And if there is one single thing you take away from all this, it should be this. The days of thinking of your pension as a simple tax-free inheritance are over. Planning ahead is no longer just a good idea, it is absolutely critical. Now, before we wrap up, I have to make something really, really clear. All the information we've talked about today is for general guidance. It is absolutely not a substitute for getting professional financial or tax advice that's tailored specifically to you and your situation. So if you're sitting there thinking, okay, I really need to get on top of this, the best step you can possibly take is to talk to an expert. The specialists at My Tax Accountant live and breathe this stuff, and they're perfectly equipped to give you that personalized advice. You can give them a call on 028-570-8531, or you can drop them an email at info@mytaxaccountant.co.uk. Thank you so much for joining me for this deep dive into what is a truly major change in UK tax law. For more clear, simple guides on your money and tax, make sure you hit that subscribe button. We'll see you in the next one.